insights from you all. The subject has been very widely talked about in the corporate governance space. Credit rating agencies have been appreciated and also criticized on and off. However, I realize that credit rating agencies play a very, very important role, which is needed to be understood well, researched, and analyzed by the independent directors, the honorable members of our data bank initiative. Before I stop, I also would like to place before you all that as part of our initiatives for bringing insightful discussions on board for the benefit of you all, we are also starting a new series to invite one author of a book which has been bestseller, and the program is going to take place on 27th with this part of series 1. I assure you all, we are together working hard to add value to the level of professionalism the independent directors have, to facilitate the companies so that they could find the right set of people and we could move to the higher standards of the practice of corporate governance. With this, I would like to welcome one and all and would like to pass on the mic to Amit Tandon, my dear friend, founder and managing director of Institutional Investor Advisory Services India Limited. He had also been in past the managing director and CEO of Fitch Ratings India, a learned gentleman, and have also brought the concept of corporate governance index in India with the help of Bombay Stock Exchange and with the help of IFC. So over to you, Amit, to take the baton on. Thank you so much.
Thank you very much, Mr. Gupta. I am really looking forward to an invigorating discussion this afternoon. As they say, you can take a person out of a rating agency, but you can't take the rating agency out of a person. So I still spend a lot of time thinking about what's happening in the industry, keeping myself abreast of developments. And I'm really glad that to be able to moderate this session. There's one thing which I'll not take credit for this afternoon, which is the panel which IICA, which is Mr. Neeraj Gupta and Mr. Tara Shankar have been able to put together. It's really, really fantastic. We have Ajay Mahajan, who's the CEO of CARE Ratings. And then we have Mr. Sivaraman, who's the group managing director at ICRA. And we have Anando Bhaumik, who's the chief rating officer at India Ratings. But I think what makes the panel much more interesting is the fact that the diverse backgrounds which each of the panelists have come from. So Ajay's been pretty much a career banker all his life, and he's worked with a foreign bank, he's worked with a domestic bank, he's worked with, a kind of bank which was in the throes of a merger. So there's nothing about banking or its practice which Ajay does not know. Or let me put it another way, if Ajay doesn't know it, it's not worth knowing. And therefore, we're very fortunate and we'll get his insights into this, which he now brings a different perspective. The same is true with Sivaraman. He's been with the manufacturing outfit. He was in a financial services business, and then he had a very interesting role. He was in the last few years before taking over the mantle as group managing director at ICRA. He spent some time at ILFS. So he's kind of seen the good, the bad, and the ugly, all parts of the business. And finally, we have Anando, who's the Chief Rating Officer at India Ratings. He's a thoroughbred professional in the ratings business. So he's kind of seen the evolution of the industry, its standards over the last 20 odd years. Also be very interesting. I'll kick off the discussions, but before I do so, I just want to share with you my own perspective on this for a few minutes. As Mr. Neeraj Gupta said when he introduced me, I kind of moved from the ratings business to a business which focuses on governance. And one of the things which kind of struck me was that, talking to bondholders, I suddenly spent a lot of time only with equity investors. And for a long time, I wondered whether the bond markets and the equity markets spoke to each other. And if they did, it wasn't really obvious whether they were talking to each other. There were occasional instances where, let's say, Apollo Tyres decided that they're going to, borrow 10 times their net worth, where the equity investors suddenly started asking, hey, what's going on? But for the most, equity investors kind of lived in their own world, and the bond investors lived in their own world. And it was rare that there was an intersection between these two markets. And then all that suddenly changed in 2018. What happened in 2018? The whole ILFS episode kind of hit us right from the front. And that suddenly investors realized that the two markets, the equity markets and the debt markets, in a sense, are linked to each other. Because of ILFS, suddenly credit dried up for the NBFCs. That kind of reverberated into the equity markets, and then different pockets of the market started getting impacted. Be it the NBFCs for their lending, and they started feeling a little bit of the pain. Then you had products like loans against shares, which had been all the rage in 2015 and 16 and 17, and suddenly credit in those businesses dried up, and people suddenly realized that, look, it's not a blank check which is being issued by promoters. These structures do have certain risks, but the risk came much more out of the what was happening on the debt side, which fed its way into the equity side. So, someone like Z pretty much lost control of their business. You saw something similar happening in CG Power, where Gautam Thapar also ended up losing control of his business because they kind of leveraged themselves, I wouldn't even say to the hilt, but much more than was warranted by the cash flows of the business. And that story could be repeated time and again. And then suddenly the equity market realized that, if you kind of start looking at banks and NBFCs, some of their lending is kind of finding its way into the equity market, and the pain was felt. So again, a good example of that has been Yes Bank, but more recently, some of the discussion and dialogue which we see happening in LVB, which is kind of, again, pretty much gone into, it's a wrong phrase to use in this audience, but say receivership. But in any case, it's kind of going to be ceasing operations in its existing form and shape, and it will kind of reemerge in a different avatar. So it's kind of interesting how the two markets have started talking to each other. And in this context, given the fact that, the debt markets are a large part of how the equity markets play out in the overall ecosystem, what's happening in the debt market is very, very important for what is happening in the broader market. Now, if you're talking about what's happening in the debt market, you can't actually leave the rating agencies out of that conversation. They are kind of so entrenched And anytime they do anything or take any decision or change how they think about businesses or change how they analyze balance sheets, it's going to have a very material impact in terms of what is happening in the market. And as I just described, it's going to reverberate through the other parts of the market and the other parts of the ecosystem. So, therefore, it's very important to kind of understand what is happening in the rating agency ecosystem. And in this context, given the fact that, again, staying with some of the examples I spoke about, a lot of it is to do with governance concerns. It's interesting that I thought it's appropriate that we have this whole conversation on rating agencies and the role which they are going to play, on which they have played, or which they can play in the setting the governance agenda for companies. So that's a little bit of how I've decided to approach it. Now, the format which we'll follow is that I'm going to kick it off with a question. And given the fact that each of the rating agencies have their perspective, and while there might be broad agreement in the direction, but there are nuances which are which are different for each of them. And I thought it's good to flesh it out and for all of you to hear individually from each rating agency rather than one speak on behalf of the other. What I'm going to do is, ask a question and then get each of the three rating agencies to respond to that question. After that, if there are, we'll kind of continue with that for a while. And in case there are some questions which any of the participants want to address, I'm going to be kind of directing it towards the panelists. And therefore, if you have a question, if you want any specific member to answer it, please point out. Otherwise, I'll kind of throw it open to the panelists and get them to answer it. I'll just before we kick it off, I see there are about 232 participants, which is a fairly high number. You would have thought, along with the fatigue which people have with working from home, there would be some fatigue as far as webinars are concerned. But this is the second webinar I'm kind of had the privilege of being associated, hosted by IICA. And I don't know what IICA does, but they're able to kind of ensure that they've got pretty much a full house for all their events. So hats off to you. And with that, let me once more thank you all for IICA, Mr. Neeraj Gupta, Mr. Tara Shankar, and the rest of the team for organizing this event and kick it off. So my first question, of course, is going to be that, look, we kind of see the ratings which you assign, AAA, AA, single A, but are you kind of factoring in ratings, or are you embedding ratings? Are you embedding governance or factoring in governance into the ratings which you're assigning? So let's kind of do it alphabetically in the name of with the name of the rating agencies. I'll begin with Ajay. If Care can go first, after which I'll request Mr. Sivaraman and then Anando to weigh in on this. So do you embed corporate governance standards, practices, what you're looking at closely for companies which you're rating, and are you embedding it in your in the ratings which you have? Over to you, Siva.
I go first, Amit. Is that right?
Oh yeah, sorry.
Yeah. All right. Okay. All right. So a short answer to your question is that definitely governance, the quality of governance, the quality of transparency of processes, of policies that is used to run the organization is definitely a very strong factor in the way the ratings are actually assigned. But having said this, let me put it this way, that considering that broadly speaking, the role of a rating agency is to assign a value to the ability of the borrower to pay back its debt, principal, and interest on the due dates in the future. So essentially, it is very vital for us to also have a significant amount of focus on performance parameters. Having said this, governance is definitely a part of the evaluation of the management and the audit frameworks, the board management frameworks that the company has established in the way it runs its businesses. The last sort of point I would make is that we, generally speaking, till now, use governance more as a hygiene factor for a basic level of the or rather a basic level of governance is assumed. And should there be, in our analytical frameworks, should there be any doubt on that, we use typically a notch down on governance rather than a notch up in terms of the way we actually look at companies from a management risk and governance risk standpoint. So definitely factored in, however, not necessarily notched up for good governance. A basic level of governance is assumed, and if we find lack of some of those processes, the robustness of the governance framework is not seen to be enough, then it's a notch down factor in our ratings process.
Thanks a lot. I think there's a couple of interesting points which you raise, and at some stage I'd like to come back to it.
Sure.
The one among the things which I'd want to focus on is the audit framework, because again, the auditors play a fairly important role in the ecosystem, but it'll be interesting to understand how the rating agencies are kind of looking at viewing the auditors in today's environment. Let me kind of move on to Mr. Sivaraman. Would you like to come in on the same question?
Sure.
Do you embed governance practices in the ratings that you assign?
Yeah, thanks, Amit. I think it's a loud yes. When the rating agency rates a company for its ability to service its debts, a lot of it is around the future, meaning that in future, the probability of default will decide what kind of rating the company gets. When you talk about future, then it needs to be very closely embedded with the sustainability of this entity over the long period of time. And governance is one of the most important things, clearly, that influences the sustainability of the organization. Clearly, balancing the interest of all the stakeholders is what I would say represents governance. The stakeholders being the shareholders, creditors, employees, vendors, and whoever else is involved with the company in any manner. So then if you have a listed company, then you also have the public shareholders. So the independent directors have the fiduciary responsibility, in my view, to take care of all the stakeholders in the organization. It's not in a kind of in a manner that is prejudiced or preference in favor of anyone. A lack of balance will definitely hurt one or more stakeholders, which will lead to disruption in a future. The one of course assumes that the interest of each of them are generally conflicted, but that's not the way governance works. Governance ensures that these are very well balanced. For example, if the creditors' interests are not balanced well with the shareholders and employees, the company will be challenged to get secure debt capital in future, for the simple reason that any kind of a default or default-like action will affect their ability to raise capital, not from just one or who they might have borrowed from, but the entire universe of lenders. I think it applies to employees also, to be able to attract high-quality employees, which is basically the lifeline of any organization's survival over a period of time. Will definitely need the employees, whether their interests will also have to be taken care. So in that context, rating is a completely important piece. And the good or bad thing about embedding the weightage for governance in the overall rating, and the basic point is that the governance is not a science. Assessing governance is not a science; it's an art, right? You look at multiple factors. There is always a hiatus between the substance and the form. right? Will compliance with the forms satisfy one to say that this entity has a high level of governance? This is a challenge that every analyst faces when he sits down to get the rating of an entity going. As Ajay mentioned, yes, there is a fundamental based rating initially, and then there's an adjustment, generally a downward adjustment, if the company scores negatively on the governance aspect. When we do this governance rating, we do rather governance assessment. We take care of the size and composition of the board, what kind of members are on the board, whether there are any issues or the companies in which these directors are on board have also had in their past. What kind of disclosures are there? Is it more than the regulatory requirement or purely regulatory requirement? Even, for example, whether the board meeting for approving the quarterly results, is it held just before the regulatory deadline or sufficiently early? The kind of investor presentation and the communication to the general public, whether there is a transcript available very quickly after any kind of investor conference is held. How the decision making is done? Does it look like concentrated? Another thing which may not be very obvious will be the promoter pledge of its shareholding, because sometimes the promoter pledge is significant. Then it will affect the ability of the company to raise further capital. The financial flexibility gets affected. So all of these are looked into, factored in. At the end of it all, it's about being subjective about it. There is no mathematics that we cannot attach a mathematics to it. So that's something which is important to consider. So all of this finally gets into a kind of a rating that rather the rating score, which is a positive, negative, or neutral. That's what actually works on. Generally, as Ajay mentioned, the negative scores are factored into the rating to be able to. Sometimes it can be even a more than one notch downgrade from the fundamental rating. But that's what it actually demonstrates the criticality of governance from the sustainability of the organization, and thus by ability to service the overall debt of the balance sheet of the company.
Thank you. Thank you. We have a very engaged audience. Even as you were speaking, there were some questions popping up, and I think you've got shades of answer. Venkatesh asked a question in terms of when you're looking at it, is it both quantitative and qualitative? And I think you've kind of thrown some light on it. And it's interesting that both Ajay and you have kind of pointed out that, look, bad governance pulls down the rating. It's not that because someone is well governed, you're going to kind of move the rating up, which at the end of it depends on the financial parameters. So that clearly is, if I may say, one of the, something which is emerging from what both of you have said. Anando, over to you. Your take on the same question.
Sure. Thank you. Thanks, Amit, and good afternoon, everyone. I don't think governance is a tick in the box or can really be, constrained into certain numbers. Obviously, it's an important part of the rating process. It establishes sustainability and long-term viability of the company. At India Ratings, our criteria and approach to corporate governance and how that is factored into ratings available on our website. And both we and Fitch, we've noticed that there are, correlations between the quality of governance and some of the frameworks that we use. For example, effectiveness of the board, independence, the role of independent directors, the sort of vision and the effectiveness of the management, the checks and balances that the company has between its stated objective and the short-term incentives that the management has. Which includes related party shareholding, related party transactions, the governance structure, the structure of the holding pattern, and then the level of disclosures that a company has. And apart from governance, also now the scope has been widened to include aspects of the environment and social aspects as well. So the governance paradigms sort of being expanded into the ESG framework, for which a lot of work has already been done in the last few years. I think a lot of governance becomes really a headline stuff when something goes wrong. And Amit, you talked about some instances from the recent past when obviously rating actions effectively become very precipitative, because obviously events happen which no one had expected. And so therefore, there's often a jump to default or a large cliff effect. But also as part of our day-to-day interaction when we rate companies, a lot of the signals that we pick up in terms of what is getting disclosures, what is the timeliness of that disclosure, what are the checks and balances that a company has to ensure that it doesn't run foul of any regulatory risks, what are the personality of the people that we encounter, people who handle risk, people who handle effectively in charge of compliance part. Do they have a voice? Do they sit on the main table and are they heard out? Do they have a say in terms of what the direction and the business strategy should be? Are they there to provide counsel and temper if required in terms of what, let's say, the business people are saying? That is something that we look for. And then similarly, when you talked about audit, we do try and interact with some of the directors and the independent directors. And then we try and see what are the processes that the company follows to ensure that A, to find out whether these checks and balances are working, and B, to figure out whether what the numbers are getting reported, are they reasonable? There are obviously, audit is a statutory requirement, so there will be auditors, but is, for example, the sampling, the quality of the audit, the sort of things that they're looking for, are they reasonable? Are they really getting into the crux of the matter? And are they really looking as to whether the numbers are sustainable? Are they comparable with peers? I think those sort of discussions are very important for us because when we project, ratings, of course, are looking at what the performance of the company is likely to be. And so therefore, while we could take a call basis what the past has been, but in case the past numbers are not truly representative of what the company has actually done, then obviously we run into a problem. And then so those kind of discussions become very important for us to really convince ourselves and then the rating committee and then to the investors at large that indeed what you see in the numbers in the company is actually truly representative of the risks and the business the company does. So it is important for us, but what we typically see at times are the headline effects when ratings get downgraded. But in most cases, they sort of stay at the background and they help us decide whether the forecast that we see, the business plans that we see, whether we think they're sustainable and truly reflective of, what the company has done in the past.
At least there's broad consensus. All of you are kind of factoring it in, as Ajay described it, whether it's a hygiene factor or it's something which is a tool which is used to check validate the robustness of the business plans and the numbers you're seeing is something which, you'd kind of look at, but it's there. Now, one of the questions which has kind of I thought it's worth discussing is that, given the fact that we do place some degree of emphasis on the governance, how do we kind of look at the fact that if we look at a large number of state-owned banks and we look at a large number of state-owned entities, where we believe that the governance is not up to scratch. And when I say governance is not up to scratch, it's in terms of, at least for the listed entities, and be it, the fact related party transactions, they don't need shareholder approval, be it the fact that the boards are not in compliance with the board composition which is taking place, be it through a host of other measures, we find that they're kind of a little bit behind what at least, forget what we believe is good governance, but is also what is stipulated by regulation. Yet, kind of tend to guide towards the sovereign rating. But having said so, there is this whole thing which I heard all of you say that, look, we will kind of notch down because of poor governance. So I just want you to reconcile this for the benefit of all of us in the audience here. So maybe Anando, let's reverse the order and you could go first on this. and then I could ask, move down to the others.
I think both issues are well recognized. The fact that if there is a company where the governance standards are not, let's say, adequate or weak for whatever reason, maybe there's a high key man risk, maybe they're not adequately invested in compliance and risk for whatever reason, that of course gets reflected in our expectation of performance, whether it be stock markets or whether it be rating. Let's say, for example, in a bank, you said there are instruments that we have that are linked to the performance of the bank. For example, hybrid instruments where coupon deferral clauses are linked to profits or the capital that the bank has. So some of those instruments obviously reflect what the standalone performance of the bank would be, and would be very different from, let's say, what a deposit rating on the bank is, because it is possible, and I don't see a contradiction there, that we say we recognize the fact that governance could be weak, but we also recognize that an entity, for whatever reason, has a very strong policy role to play, which is critical for an economy, and developing economy, emerging economy, or even a developed economy. And so therefore the sovereign has a strong economic incentive or a policy or a political incentive to continue supporting that. And that is well articulated. It's backed up by data in the past. And so therefore creditors take a lot of comfort. And this is what I'm saying is not just theoretical. We also see that in pricing, in the way depositors behave. Depositors know that service standards are very different between, let's say hypothetically, bank A and bank B, which could have different ownerships, but the deposits could still be parked with what they perceive to be the safer bank, etc. So the ratings also reflect that. But what we also recognize, of course, is from a shareholder's perspective and the government's perspective, is obviously there could be a moral hazard of continuing to support an entity that may not be efficient. And so therefore, our assumption, what we make on the likely support, could also change depending upon what are the alternatives that are available to the government to deploy or affect their policy measures. And we've seen that definitely over the years in the banking space, where there was a time when the PSU banks were effectively the only last mile link to the interiors of the country. Now that has changed over time. There are now small institutions or microfinance. The private banks have deepened their penetration. The NBFCs are a lot of them are now at the grassroots level. So there are a lot of options available to develop last mile credit, and so therefore effectively the systemic importance of the PSU banks are not in the same league. And so therefore even the government stands to supporting banks has sort of changed, and they're now encouraging consolidation. So we recognize all of that. But so to come to your point, there is really no contradiction there. When we obviously have no blinkers to say that if somebody's corporate governance is not as strong, we recognize the fact that performance could be volatile for various reasons. Whereas if the creditors, we believe that creditors can derive a lot of comfort from a strong linkage with the government for various economic reasons, then we reflect that in the rating.
Okay. So just to summarize, so what you're saying is that, and this is true to a very large extent for banks and for policy institutions, that the headline rating which you see, which would be globally BBB minus, but in the domestic market, AAA IND or CARE AAA or ICRA AAA, would be reflective of the government support. But there are other ratings for other instruments like Tier 2 or AT1 or some of those others, which would be a lot lower, which kind of reflect their standalone credit strength. That's fair, and it kind of, when you're looking at the standalone, that kind of factors in what is happening on the governance side. Mr. Sivaraman, do you want to comment on this question? Do you have the same approach, or I know Fitch does have this, or India Ratings does have mapping of global ratings with Indian ratings, but you're not constrained by that. So do you have a view which is the same or different from what Ananda articulated? Sorry, you're on mute, so if you can just unmute yourself, sir. Thank you. Yeah.
Sorry. I think Anand covered very quite extensively about how to approach the PSU bank rating, especially, right? So yes, I think the government is conscious, and the regulators are also conscious about the weaknesses in the governance structure. But at the end of the day, what we are doing is rating a debt instrument on its ability to service the creditors on time, in a timely manner. Okay, that's what basically we are doing, and we have seen at all points of time the government being able to step in to provide adequate capital, or in other ways ensure the cash flows of these banks to ensure that the serviceability doesn't get affected. So it typically, yes, to a large extent, that's what we follow. The one area where there is a difference, as Amit you highlighted, is when there is an AT1 bond, the serviceability is linked to certain profitability or capital adequacy ratios or point of time of a bank. It does get definitely rated notch down. But even there, I think the principle is same. It's all about the servicing of the interest in a timely manner is what could perhaps get affected. So these are things that get reflected in the final rating of a bank. It's not that every bank is rated AAA, every PSU bank is rated AAA by all the rating agencies. There are gaps. There are differences from the sovereign to this. They also don't get the sovereign pricing. Okay, obviously that's a reflection of that they are an independent commercial entity. There is a possible risk, if not no risk. Definitely there's a possible risk that they do factor in. So, as Ananda mentioned also, that the size of the shareholding need not necessarily be the impact on governance. Governance ultimately is the behavior rather than shareholding. That's where we need to really take a look at it.
And Ajay, do you have the same approach or do you have a different approach?
You're also on mute, Ajay.
Sorry. Yeah, can you hear me now?
Yeah.
Yeah. So I think Anando, really summarized it exceedingly well. So I will not take much time. We have, broadly speaking, the same understanding of this subject. I would just simply say that just a couple of very quick points to endorse what Anando largely said, which is that we believe that, yes, the governance standards in some of the government-related investee projects and companies could be definitely very different as compared to the private sector. However, to Mr. Sivaraman's point as well, that ultimately we are rating a company for its ability to repay on time and assessing essentially the probability of default risk. And the implicit sovereign guarantee in the public sector bank space, particularly that you mentioned, also some of the public sector financial services companies, that has stood the test of time over decades, does make a very strong difference to the way the ratings do eventually come out of the process. So there I would say the impact of governance is relatively different for implicit government guaranteed institutions as opposed to private sector. That point I just wanted to emphasize a little more deeply. And I totally agree. And I will actually take the example of one of the recently restructured private banks, where we discovered, much to probably some investors' surprise, that the entire hybrid capital issued under a certain regime of Basel was actually completely discarded at zero value while restructuring the institution. And therefore, the aggressive notching that had happened sometime in subordinated instruments on bank balance sheets, even including private sector, will, I think now it's a wake-up call to the market, to the rating agencies as well, to ensure that the hybrid instruments get a very different level of treatment at the time of rating exercise versus senior debt, which particularly in the bank context is at least the data suggests that the central bank and the government work very hard to protect the interest of the depositors. But the same can't be said on point of non-viability for hybrid instruments. So I'm just, again, endorsing what Anando said. Thank you.
I think that's a good, you referred to what you kind of seen in one of the banks.
Yes.
And I'll also take you back to the answer to the first question, which is on looking at the audit. And we have Vishesh Chandyok here, who's the senior partner at Grant Thornton India. He himself wants to know that how do you kind of, just given what has happened in the last few years, I would say, and then given the current environment, how seriously, if I may use the word, are you taking into account the audited balance sheet which is coming to you? And let me kind of put it slightly differently. What are the kind of checks and balances which you've kind of started putting in place when you receive a balance sheet from a company which you know may not be really, you kind of suspect that, what you see may not be what you get. And just do you want to walk us through some of the changes which you're doing on that from your process point of view?
Yeah, sure. I can go on this. I'll try and limit my use of time on this. So I'll just say a few things. First and foremost, I totally agree with you. I draw on my experience from banking, and as the leader of wholesale banking for in a couple of banks that I worked, prior to this, I could tell you that there is so much more work that even lenders and any financial sector player needs to still do in terms of the quality of clients that we onboard. So first and foremost, who do you work with? Who's this client that you want to work with? Do you trust his numbers? Do you trust his supply chain? Do you know what the supply chain, the suppliers, the vendors say about the customer? And how much diligence do bankers actually do before they decide that this particular company is good for a 200 crore or a 500 crore or 50 crore exposure? So the question therefore is that there is a lot of work that needs to be done before we actually select a client to be a client of our company. And I think that is something that at least I've learned through my experience in banking, which I want to share here. And now we can apply to rating agencies as well, but this is an important point I want to convey. Then the second point is that very often the numbers in the balance sheets, are being punched in. Let's understand this very well, by an analyst, right? And those numbers then move upwards into senior ranks, and then eventually they find their way into the rating committee actions at a typical rating agency. The point therefore I'm making is that it's very hard to necessarily inspect numbers for accuracy if they are printed numbers from the annual reports. What I would say here, again, more as a practitioner, less as a theoretician, would be that we need more interesting and more round-the-clock technology disruption in matters like this. We need more and more use of market intelligence. We need, and I'm saying this, we need because all of this can't be implemented very quickly, but we are definitely working at CARE on employing and deploying the highest level of technology solutions to make sure that we don't end up skipping something that is very critical and input into the rating exercise. And that's an important point I want to make. And I'm not going to belabor points relating to workflow technologies and all that. I'm talking specifically of market intelligence. There's a lot of work that rating agencies need to do. Thirdly, we all do operate in an environment where, rating agencies for some reason don't have access to CRILIC. So it also therefore forces some of us to actually spend some time about thinking and racking our brains on how best to collect market intelligence, market inputs. Because, frankly, let's be honest about it. If there is a bilateral default on a loan transaction, until it becomes an NPA, nobody comes and tells a rating agency that there is a default. We have to have solid market networks to be able to understand that default has actually happened. Because typically, the banker would want to save himself first and would give 30 days, 60 days, whatever time is required to correct that default rather than talk about it. The moment it gets talked about in the marketplace, rating agencies will take action. And therefore, there is vested interest, I would say, at the risk of using a harsh word, to actually safeguard important information relating to default from actually moving into the market very openly. And therefore, rating agencies have a bigger role to play in collecting information in a way that they can ascertain at the veracity of the information and then apply it. So there are many things more to say, Amit, but I will stop here to just tell you that this is a very, very important point you raise. And there is a lot of work that I think all of us need to do. Certainly so, CARE Ratings needs to do. And we are working on it.
Thank you. Mr. Sivaraman, let me turn to you because you kind of parachuted into ILFS and you would have kind of seen things firsthand once you went in there. And in that context, there's a follow-up question from Vishesh, which is to say that is it fair to kind of put all the blame on the auditors, or do regulators and the management also have some role to play in terms of things going belly up? So maybe you can kind of address that question when we are talking about the quality of books and the quality of accounts out in the market.
Later when I'll say, I'm being a chartered accountant myself, I like to defend the chartered accountants quite a bit.
Okay.
But I think having been a part of a fairly professional group, Larsen & Toubro for a long time, having been in position of responsibility, I think there are layers of, the gates or checks that happens. I think the best check is about the management itself in the first place, so which is where the management and the governance becomes an extremely important aspect in relying on the statement as it comes from the institute, from the entities. Second, of course, is the audit committee, the board, auditors, yes. But I think we need to acknowledge as the external parties, the auditors, the bankers, and the rating agencies have a limitation as far as getting the level of information one would get. So we need to develop alternate ways of corroborating the information that you get for review. Right? Some of this can be like rating agencies do have an enormous database about the company which is getting rated, the other companies within the same industry which are getting rated. So the level of corroboration that we need to do about the data that we finally receive becomes extremely important. Always do an inter-firm comparison, inter-industry comparison, try and see whether similar industries are having similar ratios. What is the reason for the change? So that level of intelligence is required. A lot of it may not be possible with just a human effort. As Ajay mentioned, there is a need for the technology to really play a role and highlight where are the variances, where are the gaps clearly. And yes, the being aware of the market, being in touch with the rest of the market participants, for example, even in the case of ILFS or the famous Yes Bank or DHFL, we started seeing the yields widening much earlier than the rating downgrades, obviously. So there is perhaps some message for all the rating agencies to be aware that there is more information that will have an impact on the credit of our entity than what we have on the table. Maybe there are some triggers which we need to use to be able to take a look at the financials and the rating from time to time, even without it falling due for a review. So some of these are important from a rating perspective. We need to be with the ears to the ground, be enabled technologically to be able to assess the gaps and then make sure that we ask the right questions, get more corroboration on this. So I wouldn't put the blame entirely on the auditors. There is always a scope. In retrospect, we can always say that we could have done more work. But there are gaps. Yes, I agree with you. I think even when you look at ILFS, some of it may not have been visible quite evidently to people. Clearly, it's something which we need to think through and make sure that we are on the right track.
Okay. Anando, your take on this?
Yeah, just to add on, I think the video has gone off for everyone. Back, yeah. Just to add on, Ajay and Mr. Sivaraman said, sure, we obviously a lot of time look at what market indicators say. For example, share price, price to market cap to debt, price to book value, bond spreads. We certainly monitor those and see whether the ratings are out of sync, or is it the markets are telling us something that we need to factor in. But obviously, these apply only where this for listed instruments or where the data is available. The reality is that for the vast majority of the outstanding ratings that we have, these are unlisted companies, closely held companies, and so therefore the level of disclosures also are limited. Of course, that's also partly reflected in their ratings. But I think at a very conceptual level, we certainly do not have the expertise that the auditors have, or let's say even a forensic auditor has. I think we start from where the auditor leaves off. So the auditor certifies the numbers and then we start off from there. Obviously, as part of the work, we look at what has been given to us and we try and make sense, try and see whether the numbers are making sense, whether they are in sync with what is happening in that industry. Are the margins reasonable? Are the pace of growth? Can we explain the sort of growth that the company has? Those are what we call reasonable investigations that gets done. But I definitely don't want to suggest that we can take over from an auditor. We definitely don't have the skills. We do not have, that's not our role. And so therefore, if the proposition is that the audit process itself be sort of, tightened, I'm sure, we are happy to work with the Institute to sort of see what can be done and sort of exchange notes to see what we can learn from each other. But I just wanted to emphasize the point that the audited numbers are something that we start with. And then we sort of add our reasonable checks to see whether those numbers make sense.
Okay. Thank you. I'm kind of just keeping track. So we've, at the beginning when we began the session, I said we've got close to about 240 people. A lot of them are either on the boards of companies or potential directors on boards of companies. Now, when you, as rating agencies, go out and talk, you would be talking to the CFOs and the treasurers and in some instances, the CEO themselves. So I just wanted to ask you, how do you think, what do you see is the role of independent directors? Do you see them getting involved in the process of the rating or in the dialogue which is happening with the rating agencies? And maybe just Mr. Sivaraman, maybe we could begin with you and then I'll turn to Ajay and then to Anando.
So at some level, the regulations do require us to be engaged with the audit committees of the companies. So that's something which we do both by way of the regulatory requirement and also get some more insights as to how does the company's boards conduct themselves. What's the involvement?
Do you kind of do that as a practice? Do the analysts go speak to the audit committees?
It is mandatory. It's mandatory under regulations. So in any case, we speak to that. That's one. Otherwise, the engagement generally tends to be with the executive management, which could be the promoter owner or the managing directors, sometimes the chairman and the CFOs. These are the typical areas where we end up having a lot of conversation. Independent directors, no, we don't specifically speak unless there is some corroboration that you would need specifically. That's what we do.
So unless they're a part of the audit committee, where again, I suspect you'll end up speaking to someone who's a part of the part of the executive management, that might be a best fit.
Audit committee meaning independent directors.
Okay. Ajay, what about you? You're on the same process?
Yes, Amit, we all are under the same regulatory process, and I think must have been a sound reason for the regulator to introduce this as a requirement. But it's a good requirement to our mind also, because it allows us a very wonderful opportunity to actually interact at senior levels, at the board level, at the independent director. Typically, the audit chair is an independent director. So it gives us an opportunity to actually ask questions that are more incisive. Very often, when you talk to management, you obviously are going to get answers which are in favor of the performance of the company. It's very important to use this massive opportunity to reach out to the audit committees. Clients are also happy to put us through. And when we talk, it's important. And I think I'm only focusing on what we could do better. So what we could do better is use this opportunity internally as an organization to get better insights on the governance standards, on the policy frameworks, on not necessarily just on accounting policies, but on the robustness of the internal controls, for instance. How's the internal audit working? And, do they have an independent line without it going into the management, into the audit committee frameworks? So there are loads of such I think issues that define ultimately how the corporate governance standards in the company are, and we are increasingly seized of this as the best opportunity available to us in our surveillances. Once in a year at least, it's mandatory to meet the audit committee. So we use this opportunity more effectively. We are getting better at this, Amit. I can't say that we are perfect at it. We are getting better at it. It's a process and it needs to be applied. And very often the process is not uniformly applied. It's applied to larger accounts first, then to medium accounts, then to small accounts. But we need to actually look at this also on another dimension, on another scale, where our concerns are higher. We need to use audit committee frameworks for better understanding and explaining to ourselves how the governance is working.
And Anando, your take?
Yeah, I think as far as the regulatory requirements are concerned, we have made a start. I think this was a requirement that SEBI came out about a year ago. And now after the March results, I think it's been about 6 months that all the agencies have been doing this. So, but apart from listed companies, to be very honest, I've seen a bit of a reluctance on part of the directors, independent directors, to sort of expose themselves. Maybe their question that they have in their mind is, the management may be best in the best position to answer business questions, which is true. But I think it'll be good if independent directors all of you on this forum here recognize that creditors obviously are a very important stakeholder, and then to realize what is it that rating agencies or the banks ask for, the level of disclosure, the sort of query into the checks and balances that the company has. The questions that the independent directors raise at the board meetings, I think those are great insights for all of us to be able to understand and be comforted that, okay, there is a robust discussion at a board meeting, and the board meeting is not just one-sided, where just one side speaks and the others are just listening, and that there is a great amount of deliberation. So I think that the interactions with independent directors are very helpful from us, not so much as a fact capturing mission, but just to get a sense in terms of the robustness of the discussion and the willingness and the ability of the independent directors to question and push back the management when required. That's a very important input for us in our rating exercise.
It's interesting. You've kind of started meeting the audit committee because one of the things which we've observed, and this is much more for the global investors rather than the domestic investors, they now want to meet up with the independent directors and chat with them. So as you point out, there is some reluctance on the part of the management to kind of open up their independent directors to the investors. But we've also, my experience is also that the independent directors themselves are a little bit reluctant to go out and meet up with the investors. And their response is that, look, rather than discuss one company's issues, those of them who are on more than one board, say, can we, talk about the fact that they're more open to having a general conversation regarding what is happening in companies and what the practices are, rather than get involved in specifics. So I guess this is a space which is going to kind of change in the coming few years, because investors want to meet, regulators want you to spend time with independent directors. So therefore, I think companies are going to find it, or managements are going to find it very difficult to kind of hold everyone back. There are a lot of questions in terms of, your own. I know there's been some discussion as you've all answered questions in terms of your own internal processes and do they conform to the best governance standards, just given the fact that if you are writing out from the eye of a storm. And it'll be good to kind of ask you about some of the changes which you've brought about in your governance, in your processes, in your practices. But before that, there's a quick There's a quick question, which is that, look, are there any examples of companies where you've kind of downgraded on account of governance concerns or not given it the rating which the financials would have suggested because of governance concerns? So are you people, if you're open, do you want to give some names? Ananda, maybe you could begin and then the other two.
Yeah, sure. Obviously, if a rating is not accepted because of the management, we have had expectations of the rating, but we, because of governance concerns, were not able to match that expectation. Obviously, can't discuss that. But a couple of examples from the last maybe 12 months or so. Everready we downgraded because of intergroup transactions. Debt just ballooned. And those sums of monies are still coming back. It's been a couple of years, still taking time. Then there was Vadilal, good company, solid brand, but then there was infighting between the promoters, and that disrupted examples that I can readily think of where there was a downgrade where, because of what we call governance issues in the public commentary. And then there are sectors which are, which have traditionally been a bit opaque. For example, gems and jewelries, where a lot of what the company does is basis, say, valuation and what's the standard of valuation, or the sales that they do are to, unlisted companies in, say, in gateway economies like Hong Kong and others. And so there it is often a bit sort of difficult to understand, go beyond the numbers and to understand or validate some of what has been done. Similarly, in real estate, there could be situations in terms of how the accrual is being done on the project, on the stage of the project that has been completed, and how the company's been doing it. Are there any related party transaction, etc. From holdco levels? Is the holding structure of the SPV clear enough? We've seen that in infrastructure companies as well, where leverage effectively built up at the holding company. So these are some ready examples I can cite where over the years we've seen ratings sort of getting compressed or getting impacted because of our inability to fully understand what is going on, not just in the company but in all its associates and group companies around it.
Mr. Sivaraman, any examples?
I think Ananda has covered it quite extensively, and I think at the end of the day, governance is a composite, it's one of the inputs to the rating. As we said, it's only an assessment rather than a specific score. So I think it should not be appropriate to discuss individual cases.
Ajay, do you want to give a name, or would you rather stay away from discussing individual cases?
Actually, I mean, I would have given names, but I don't have that much of history on the company yet. But I can, without giving a name, I can talk about a particular sector in gems and jewelry, where we consciously exited from rating relationships across the board for a multitude of companies where we suspected some wrongdoing, and this was largely through market information. And this goes back to my earlier point that we need to continue to beef up our intelligence from the market sources, whether it is from bond yields or it's from bankers or it's from suppliers. But we need a lot more information, particularly in those companies where we suspect governance is not very strong. So I have nothing more to add here, Amit. I would have happily shared names. I can't think of them right now.
That's okay. I have a follow-up question, and it kind of stems from the fact that we've seen a lot of auditor resignations, and the equity market actually takes that as a signal that look, everything is not okay, and there are some governance concerns. So, withdrawal of ratings being viewed in the same way? Does it kind of emanate? Is your experience that these mainly emanate from governance concerns, and therefore it should be viewed as a red flag?
Who goes first? I'll go.
Yeah, sure. You have the mic in front of you, so do
Okay.
others. But anyway, since the microphone is out with you, why don't you go, and then Anando, and then Mr. Sivaraman.
Okay. Again, I don't want to hide behind this, but honestly, I don't have enough enough experience to.
So you've muted your, you've got muted, Ajay. Thanks. No, again.
I just clicked it once, but I think it just toggles a couple of times. Sorry about this. I was just saying that that I don't have necessarily as much experience in ratings to be able to say whether in the past withdrawals of ratings always reflected discomfort with the governance standards of the companies, or there were other reasons. That is very hard to establish. My sense is that yes, it would have been a close map between discomfort with the customers. Either rating expectations, because very often customers rating expectations are always very high, and when the rating agency announces its decision perhaps to downgrade or a potential downgrade, the company could develop discomfort with that rating agency and may decide to talk to somebody else. So there could have been multiple factors in regard to the exit of rating agencies in the past. But I want to make one point clear, which is that earlier the exits were easier. Now it's not so easy to exit a particular relationship, because the rules are that you have to treat the issuer, continue to rate the underlying liability until its maturity. And if there is an exit before that, you need an NOC from multiple banks. Anindo and Mr. Shivaraman, if they know better, they can add to this. But this is my understanding that the INC cases are ballooning in rating agencies. So customer doesn't necessarily continue to maintain the relationship from their perspective with the rating agency, yet continues to find a rating coming from the rating agency for the purposes of continuity. The regulator has made it mandatory, and it's only a certain time after which you can drop this case, maybe 12 months, maybe 6 months. I'm not exactly familiar with that. And before dropping, you need NOCs from the lenders for the rating agency to stop the rating on a particular instrument. So this is my understanding, and as a result, exit barriers have got loaded up, and this has also created a massive amount of overload in the rating agencies. We have to do work for thousands of companies that don't pay us for this work. So that's a separate crib, but I just thought I should mention that exit barriers have increased in this respect.
Okay.
Yeah,
Anando,
one of the reasons why is because the regulator sort of took a feedback from the markets and the banks and creditors to say that withdrawal of an instrument, once it has run out, obviously is par for course, and that is perfectly. But to withdraw coverage, where the entire coverage by a rating agency gets withdrawn, or an issuer turns non-cooperative, I mean, that felt was probably to either as an indication of rating shopping, or because the issuer felt that its performance was deteriorating and wanted to avoid a downgrade, and so on and so forth. So I think, so to answer your question, I think some of these like withdrawals and non-cooperating are viewed negatively, and the regulator has taken that feedback and has sort of increased the bar has made it more difficult to sort of withdraw those. For non-cooperating ratings, for example, now there is a requirement by SEBI that after 6 months after non-cooperation, the ratings compulsorily have to be downgraded. If it's an investment grade to a non-investment grade, and after 12 months of continued non-cooperation, no new agency can rate that agency. So the barriers have been significantly increased, and I think the culture is to actually discourage withdrawal and non-cooperation.
There's a comment which is coming on the chat that you're supposed to take now monthly statements also from entities, whether they're current with regard to all their dues. And Anando, do companies readily give this information, or are they again reluctant and you have to kind of extract it from them?
At times it can be quite difficult, and I think the experience is quite mixed. Listed companies, of course, there's a exchange requirement, and they have to inform the stock exchange every time they make a coupon or a principal payment on a listed debt. For the BLR, the bank loan ratings, it's a bit of a mixed experience, which goes back to the point that Ajay made at the beginning, that for us to be effective and to be able to tell the market in a timely manner what has been the track record of the company, we are not able to rely completely on the requirement that companies have to give us monthly statements.
Okay.
The point that we should be given access to the banker database.
Okay. Mr. Sivaraman, do you want to come in, or should we just move on to another
I think we can
question?
move on. I think nothing significant to add except that the rating agencies don't have an exit option. The issuers have an exit option by not cooperating. That's all I can say.
Okay. So I'm going to kind of deviate from or take a tangent, go off tangentially from the main subject, which is, rating agencies and the role of rating agencies in the governance. And I just want to it'll be good for the audience here, given the fact that a lot of them are on boards of companies, to hear about some of the processes and some of the checks and balances which all of you as rating agencies have put in place, particularly given the fact that there's been a lot of adverse press which you've got over the last one and a half years. So do you want to come in, and maybe you could, Mr. Sivaraman, maybe you could begin just very briefly. I know since it's not a part of what we were supposed to discuss, maybe just a few paragraphs or a few short minutes on this.
Few paragraphs will be long. That's something which we do with the regulators. So let me restrict it to what has happened actually. There have been management changes within the company. Like I've taken over as MD and CEO. There is another gentleman with a rich banking background who has come in as a president rating, looking after the rating functions. Right. Otherwise, given that it has been a Moody's organization, the processes have been robust. It's just that the internal control have been enhanced to a level where possible deviations or misses in process compliances have been reduced. So that's something which we have put in place. In any case, the regulations required, and we had always practiced that separation of commercial function from the analytical team. Right. It is now with the new regulations, it has gone one level even further. But that's where we are. I think all the rating agencies, as I said, whether did we make a mistake or were we not aware of certain sets of data? Perhaps the latter is largely true, because then we need to stay connected to ensure we have adequate corroboration of data from the external sources. That's perhaps something which all of us put in place to enhance. I'm sure Ajay will confirm the same thing. Ajay.
So Ajay, your take?
Yeah, so I totally endorse what Mr. Sivaraman said. I can get into some more specific details, but basically a high-level answer is that the entire board, and here I would just say that on our board, of the 6 board members, 5 of them are independent board members, right? So they have been navigating this company for the last at least many months in terms of interactions with the regulators, post the 18 to 20 problems that we saw, 2018 to 2020 problems we saw, and there is no denying that fact that we went through a difficult time as a rating agency. There is no point denying that. The fact is that that's all passed, and the board has played a very constructive role in through its audit processes, through its risk management committee processes, the risk supervision committee processes. The processes have got very deeply articulated right from the board level down to executive management and down to the processing and analytical staff. So processes. A lot of advice has also been obtained from a number of advisory firms, at least a couple of them, and they have come and taken an outside-in view of our processes, and also suggested and recommended changes to make them more robust and transparent from the perspective of the way from the point of the rating mandate origination to its getting logged, to how the information flows, to how the analyst puts together the rating note. The entire process has been worked upon, and checks and balances created, information coming directly from the system and workflows are being changed wherever technology is involved. It'll take a little bit of time, but all of that has been worked upon. What is important also is to mention that processes relating to credit audit, for instance, we have a criteria and quality control team. The QC team is focusing a lot on auditing, selecting some names from the portfolio, especially those that are highly rated credits in our portfolio, to make sure that there is no exaggeration in rating anywhere. So there is an independent credit audit process that is done, and the findings of that process are tabled to the risk supervision committee, which is chaired by an independent director. There are many other things. Rating models are being affected. More than 85% of our portfolio now has model coverage, and the balance 15% is being addressed as well. Systems are being upgraded, like I mentioned to you. RBI inspection, SEBI inspection reports in detail have been responded to and have been finalized, much to the satisfaction of the regulator. So a lot of work, Amit, has been done here by the board. This precedes my time as well, but my job is obviously to continue to focus on this and make sure that we stand only for quality going forward.
No, that's most helpful. And, the emphasis on the processes and the fact that, in your instance, it was pretty much the board of directors which kind of managed the affairs of the company for a while. Ananda, I'm going to ask you the same question, but with a slightly different twist, which is the fact that, given the fact that Fitch owns 100% of the business, how much of those processes do you kind of import from the global offices, and how much of it is grown in-house on the basis of the external environment which you see? And can you kind of give us a sense of that?
Yeah, I was about to say that I've been with this firm for 20 years plus, and I've seen these really embedded ever since I've been in this firm. The code of conduct and code of ethics that Fitch has is the same that we have, and so therefore that flows from a global structure. Obviously gets overlaid by what SEBI requires us, and we've seen that at times some of those SEBI requirements are more stringent, and they're stringent because SEBI has chosen to go on a rule-based regulation rather than a principle-based regulation, though global regulators are also in a way moving in that direction, but SEBI is far more hands-on, I think, in some of these things. So, but certainly, I mean, in India ratings, and you were with us 10 years ago, you would have seen some of these. I mean, the segregation of commercial and the analytical piece, the role of compliance, a strong role of compliance. You talked about processes, policies around how to handle an external tip, anonymous tip, how to handle a complaint by an investor or by an issuer, the entire review process, the appeal process in case an issuer doesn't like the process. All of that just goes to reinforce the values of independence and transparency that we have. Similarly, in terms of compensation as well, I mean, the very small role of variable pay on the analytical side, the fact that analytical compensation is linked to quality of work rather than the performance of the company. And of course, being part of a large conglomerate, we are able to take benefit of the diversification globally rather than get constrained by performance in a single geography. So some of those checks and balances are something that I've seen in India ratings all my life. But of course, it's an evolving world. The volatility in business is getting stronger. We've already discussed about volatility in numbers and whether audited numbers can be taken at face value. So obviously, a lot of our efforts at looking at code of conduct is now focused to see, the quality of the interactions that we have with different stakeholders whom we interact with during the rating exercise.
Very mindful. We've had a fairly lively discussion, and we're kind of pretty much nearing the end of the 1.5 hours which was allotted to us. I still a few minutes left, so let me kind of ask you all for your closing comments on this subject in terms of rating agencies, governance, and do you think they can rating agencies comments in terms of whether rating agencies can play an even greater role in our ecosystem to nudge companies for better governance, and if so, how? So just your closing comments, and with that, we'll bring this session to a close. So Anando, you were last, so you can begin, and then Mr. Sivaraman, and finally, we began with Ajay, so I'll request him to have.
Thank you, Amit. Yes, very well conducted. A great audience. Take advantage of this audience. I mean, all of you are on the boards of companies. Please do, whenever you wish to, please do interact with rating agencies, not to sort of, understand the rating process, but to understand the perspective on governance. We'll be very happy to come and explain to you our perspective, why we are asking for what we are, and how is it, the question that the analysts ask may seem, in case they seem disjointed with the business, then there's a reason why the analyst is trying to probe and understand whether the numbers make sense. So I think it'll be very useful for all of us to understand the expectations that creditors, rating agencies, the market has in terms of periodicity of disclosures, in the quality of disclosures, in the process that the company has internally to make sure that there are adequate checks and balances, to give us a flavor of the quality of discussion that goes on at the board level, to get a flavor of the level of strategizing that the board does, because that would help us understand as to whether the company is focused on long-term issues or whether it is focused on quarterly matters and is really struggling and grappling with short-term issues. I think those are going to be, and I just wanted to take advantage of this forum and thank you all for this, but those are discussions that we would really like to continue and take forward. So thank you, Amit.
I think Ananda has been quite elaborate, as he has always been right through this session, being clear and specific to the set of points that one needs to cover. I think just to add on to that, as the rating agencies, our analytical team, when they explain the rating outcome to the clients, they do emphasize, cover this aspect as well. Hopefully that will register some level of improvement in the governance practices of the companies. Ultimately, we are all the kind of lubricants for capital flow across entities. What the role of the rating agencies is clearly. I suppose that these inputs will be taken positively. As far as the independent directors are concerned, I think the regulations are changing. Companies Act is expecting a lot more out of the independent directors to take care of all the stakeholders' interest. So perhaps from a ratings point of view and the creditors' perspective, in addition to all the typical questions on financial performance, cash flows that the independent directors could ask, they could ask questions about when they approve a certain loan for taken by the company, take a look at whether the terms are unusual, why are they unusual, what is the reason for it, what is the risk of a default, and what will happen. That's something which will be helpful. Please do ask the companies about their upcoming loan servicing obligations. Are they well endowed to be able to service that obligation without a default? These could perhaps keep the management also well focused on it and will avoid any surprises. I think this is something which will ultimately help the companies to become a very, very respectable entity from a lender and rating agency point of view. That's what my question.
Right. Ajay, as I said, you began it, so you should have the final word.
Yeah, so I think Anando and Mr. Sivaraman have covered everything. I'll just simply say that the market will get increasingly more sensitive and increasingly more appreciative of good governance over less governance. I'll not call it bad governance over less governance. I think the company's reputation will play a bigger role going forward. That's the way I see it. I think the crisis that we have seen in India, semi-crisis, may not have been a full-blown banking crisis, but certainly a deep NBFC crisis and impacted all parts of the fixed income and lending markets in India in 18, 19, and 20. This crisis can't go wasted. I think a lot of processes have got bolstered, supported by the regulators. I think what this crisis will certainly should not, and we should all make attempts not to let this crisis go waste. We have all learned our lessons. Some of us have learned deeper lessons than others, but we've all learned our lessons. And I think we will, at least in the way we operate, we are totally committed to staying focused on quality. It is quality all the way. And I also believe that not just the rating agencies or investors, but equity investors, shareholders, all of them will continue to give more premium to companies that are run properly with strong governance. And there should not be any compromise on corporate governance. The promoters better learn that lesson. Those that tried to use shortcuts have maybe succeeded for 5 years or 10 years, but have eventually luck catches up with them. So the reality is there is only one way, which is quality focused, transparency, and make sure that what the financial statements that are issued, the disclosures that are issued are honest, and only that's the right way to build a business. I think that learning should be there across the board. Now, this is tautological in many ways. Some people will still err. I guess that's something that we can't avoid. It's our job to filter those credits out and treat them accordingly from a rating perspective.
Thank you. I think that kind of sums it up very well. It's been fantastic listening to the three of you and getting your perspective on it. What clearly stands out for me is, if I may say, two aspects. One is the fact that the regulators themselves are driving some of this change, and it's kind of taken two forms. One is in terms of what and how the rating agencies behave, and the second part, which is more equally important, is the emphasis which they've placed on governance, which is kind of filtering through the system. And the second is the changes which the rating agencies themselves have brought about. One is to their internal processes, systems, and ensuring that they are far more robust. But equally important is the fact that their own focus is kind of looking at much more than numbers, but looking at, again, the governance standards, the governance processes, the governance systems, which are there in the companies which they are rating. So that is something which is very important, and that is something which all of us should continue to focus on. So with that, I'm going to thank you, and I'm going to hand you over to Mr. Tarashankar to kind of give his closing comments on our panel today.
Good evening, honorable dignitaries and most valued guests. It's my privilege to propose the word of thanks on behalf of the entire team of IICA. I extend our sincere thanks to Mr. Amit Tandon Sahab for taking out time for being the moderator for today's panel discussion, in spite of informing him quite late. A warm thanks goes to our esteemed panelists for sharing their valuable and practical views with our participants. And I'm sure this discussion would be quite informative and fruitful for our participants. Finally, our special thanks goes to our participants for attending the event, and we are sure this will definitely help them. So thank you all so much, and definitely we look forward to same in future also, and we'll keep on conducting such kind of sessions so that our participants could benefit out of it. Thank you, and thank you so much for being a part of this. Thank you, sir.
Thank you.
Thank you all. Thank you, Amit. Thank you all.
Thank you.
Thank you, Ajay. Thank you, Mr. Sivaraman. Thank you, Anand.
Thank you.
Thank you, Mr. Tarashankar, Neeraj. Thank you.
Thank you, Amit and Sivaraman Saab, Mahajan Saab, and Anandoji. And what I could collect, like I got so engaged in the discussion, the way it has been, and the beautiful part of it was very smooth, the going entire discussion in a story way. And I would like to underline one very important sentence which Amit could share with us, like what rating agencies had been doing, are doing, and are likely to do or engage with in terms of having more engagements in corporate governance as a critical parameter, and linking it with what Anando has said for the independent directors to have more engagements, understanding and discussion with the rating agencies, not only understanding the aspects, but also to make them understand how exactly the governance operating systems at the companies are working. So I'm sure with this, there are enough takeaways for each one of us, and also for the credit rating agencies. And I assure you on behalf of IICA, especially to the companies on board with their leaders as experts to the panel, it would be our pleasure to engage more by way of having more discussions, or if we could facilitate or in terms of some research that could again bring more insights to this, because the data bank initiative has so far around 23,000 independent directors of the companies sitting in listed and unlisted companies. So I'm sure engagements on critical aspects as to how in a collaborative manner, the credit rating agencies and independent directors could work to make more interventions could be the action agenda for tomorrow. So once again, thank you. Have a great evening to all of you, and best wishes for staying safe and healthy in these times. Thank you very much.
Thank you.
Thank you. Bye-bye.
Bye.